Well, my next guest says the stock market has essentially gone blind and is no longer the long-term discounting mechanism that it used to be. Hedge fund manager Bill Fleckenstein joins us now. He's the president of Fleckenstein Capital in Seattle. Bill, good to see you again, as always. And okay, so why has the stock market lost its discounting mechanism?
Well, thank you for having me back, Betty. It's my belief that if you take a step back, the stock market did a poor job of discounting the bursting stock bubble in 2000. It just kind of went over a cliff, and did not discount at all the bursting of the even bigger bubble, the real estate bubble. Yeah. And I think this is a function of the fact that really, since Greenspan took over the Fed and serially bailed out bigger and bigger problems with more and more easy money, the market evolved into much more of a speculative casino, and a lot more momentum-type traders began to operate, and everything always resolved itself on the upside. Right. In the mid-'90s, a lot of computer power came in, and we had a lot of quants in the last decade reverse engineer what worked, and so we've had much more of a speculative market that seems not to discount problems. So I came up with my own, pop reason as to why, but it's been quite clear that the market has not discounted big issues much in advance at all. Right. Over the last
it's not
decade.
As insightful as it once was. And is that why, Bill, then you see a very large trading range then for the markets?
Well, that's not specifically the reason. I think that the big bounce we had off the lows has kind of run out of gas. The economy's sputtering. We did nothing towards solving the unemployment problem. Not that there was much the government really could do, but the real estate market is still in trouble. The next thing the Fed's going to do is find a new way to print money, and that'll give the market a bit of a boost. But against that, we have the problems that I just cited, and then the problems in Europe, et cetera. So I don't see how the market can really go up and make new highs. On the other hand, if the Fed's going to print money, maybe it can't go down that much, and the S&P might trade in a 200-point range, between say 950 or 1,000 and 1150, and maybe a little higher than that. But
okay.
Hey, Bill,
1,000 to 1150.
Yeah. Hey, Bill, it's Adam. Let me jump in here. If you use, say, $80 for earnings for the S&P for this year, given where we're trading right now, it's about 13 times. I mean, historically, that's pretty cheap. So how much farther down do we have to go before we take out that fluff you're talking about?
Well, Adam, 13 times is only cheap relative to the last decade and a half. I mean, if you look at other periods of problems, the 70s, or when the market brought it in '82, the market was about 8 times trailing earnings, and dividends were about twice as high as where they are now. So it's all kind of relative, I don't know how much of those S&P earnings, since there's a decent chunk of financials in the S&P. I mean, all the financial earnings are just pure nonsense. They're making it all up. We don't know where assets are priced necessarily, and they're bailed out on the back of the Fed putting rates at 0. So I don't believe the earnings, and I don't know what the multiple is going to be. Okay. But it could easily trade at 10 times. Why not?